Subscribe to my channel Report Stock.
Welcome back to the Deep Dive. Today, we're unpacking the latest performance from a name lots of pet parents know well, CHWY Inc.
Yeah, CHWY.
We've got their newest financial report, some analyst takes, basically trying to figure out what's really going on.
Exactly. Our mission, if you will, is to pull out the key stuff from CHWY's Q2 fiscal 25 results.
Right.
Look beyond just the numbers. Understand the strategy, the market forces, and maybe what it means for you.
Okay, so let's jump in. The headline figures, they look pretty good, don't they?
They really do.
Adjusted earnings, 33 cents a share. That blew past the estimate of 14 cents. I mean, that's a jump of, 37.5% year over year.
A huge beat. Yeah.
And net sales came in strong, too, over $3.1 billion, beating the $3.08 billion estimate. So what's the immediate takeaway there?
Well, it's not just meeting expectations, is it? They clearly exceeded them. That signals really strong execution.
It's operationally sound.
Right. And gaining market share, too. It points to a healthy business internally, which honestly makes the stock's recent performance a bit puzzling. We'll get to that.
Okay, yeah, let's park that for a moment. What's driving this growth? Because the AutoShip program seems huge.
Oh, absolutely central.
AutoShip customer sales were up nearly 15%, hitting a record $2.58 billion. That's like 83% of their total sales, mostly consumables and health stuff.
Which makes sense for recurring purchases.
Yeah, though hard goods also grew 15.2% and consumables overall 6.6%. But is putting so many eggs in that AutoShip basket a risk?
That's a fair question, but I think with pet care, AutoShip is more than just convenience, It's about trust and routine for people's pets.
Right, you don't switch dog food brands lightly every month.
Exactly. It creates this incredibly sticky, predictable revenue. They ended the quarter with 20.9 million active customers, up 4.5%.
And spending more, too.
Yep. Net sales per active customer hit $591, up about 4.6%. That recurring revenue from engaged customers. It's a powerful engine, no doubt.
Okay, so sales are up, customers are sticky. What about efficiency? Are they making more profit on those sales?
They are. Gross profit jumped almost 12% to $942 million. And crucially, their gross margin expanded.
By how much?
90 basis points, hitting 30.4%. So for you listening, that means nearly an extra cent of profit on every dollar of sales compared to before.
That's pretty good margin improvement.
And their operating costs, the SG&A. As a percentage of sales, those actually went down slightly.
So more efficient overall.
Definitely. Adjusted EBITDA, that core profitability measure, was up over 26% to $183 million.
And how did they manage that margin gain? Was it just like raising prices?
It seems more strategic. They mentioned growth in their sponsored ads business that's high margin.
Ah, okay, like ads on their site.
Right. Plus a better mix of premium products and, disciplined pricing played a role. It shows deliberate moves paying off.
And the overall financial health?
Looks very solid. Almost $600 million in cash, no debt, about $1.4 billion in total liquidity. They even bought back $125 million of their own stock.
Debt-free is always nice to see.
It certainly provides flexibility.
Okay, so strong results, good efficiency, solid balance sheet. What are they saying about the future? The outlook must be positive, right?
It is. Management actually raised and narrowed their guidance for the full fiscal year 2025.
Okay.
They now expect net sales between $12.5 and $12.6 billion. That's about 7% to 8% growth year over year, a bit higher than they previously guided.
So confidence internally seems high?
Absolutely. The internal engine is, firing on all cylinders. But, and this is the fascinating part.
Here comes the but. The stock price.
Exactly. Despite all this positive news, the stock itself hasn't fared well recently. Some analysts have it as a Zacks rank #4, which is a sell rating.
Really? After those numbers?
Yeah. And the stock lost nearly 15% in the last 3 months, while the wider industry actually grew over 10%.
Wow. Okay, so there's a real disconnect there.
A big one. It's a stark reminder, isn't it?
Yeah.
Market sentiment, maybe short-term worries, they can paint a very different picture than the company's actual operational health.
So wrapping this up, CHWY's reporting impressive growth, digging deep into customer loyalty with AutoShip, improving margins, debt-free. Things look good under the hood.
Operationally, yes. Very strong.
Raised outlook, too.
Which leads to that final thought for you to ponder.
Yeah.
What does it really mean when a company posts strong numbers, shows clear growth, seems financially healthy, yet its stock lags behind, even goes the opposite way of its industry? Is the market seeing a risk we haven't discussed? Or is it maybe overlooking the underlying strengths?
A classic market puzzle. Something to definitely think about.
Subscribe to my channel Report Stock.